Here we are at absorption, a personal favourite out of all the principles of price action within the Wyckoff realm. An advanced aspect of structure. Well, absorption, it is structure, but I didn't want to put this in structure at the beginning, session 1, because it is advanced and requires a lot of price action skill and chart reading ability, rather than simple support and resistance. Because when we analyze absorption, we need to go in a bar by bar format, and obviously this wasn't covered at the time. And absorption is also strength. We'd class this as a sign of strength. So with absorption, we will rally. We'll find supply up here and we come back. We react down. Then when we rally back up into this area of supply, we'll go like this. We will hold a tight trading range and we'll absorb any selling that's in this area. We hold gains in effect before we move up for higher prices. Again, this is a sign of strength, and there is no absorption associated with weakness. There is no opposite. The closest we have is when we come down, so we're in a downtrend, we find support and we hug the lows. Okay, that's merely the closest thing we have. And this aspect of price action absorption is pure Wyckoffan. And it truly is a masterpiece. I mean, just to think that Wyckoff examined and noted and decrypted this fascinating part of market behaviour is nothing short of genius. Apologies for the rant. So in a nutshell, absorption is strength and there is no opposite. There is no weakness or bearish price action that would associate with any kind of absorption, apart from when we're in a downtrend and we hug the nose. That's the closest thing. However, it is not absorption. Price holds. We're unable to react after a drive up. I've just briefly explained that. So we rally, we find supply, we come back down, we revisit the same area, and we'll hold. We're unable to react after this move, this drive up. And what is this doing? We absorb supply in this area to the left where we previously had selling. It is notoriously difficult to trade. Even the most seasoned of traders with extensive knowledge of Wyckoff do not trade absorption per se. I mean, being able to recognize this structural feature is important in its own right, as absorption is rarely tested. Obviously, if you think about it, as the whole purpose is to absorb supply before markup, before higher prices. Therefore, it is worth spending time to become familiar with the characteristics, even if one doesn't decide to trade. But if recognized, it enables us or gives us a license to look for long plays. Think about it. It's very similar to a shakeout. When we see or we can recognize a shakeout, it gives us a license to look for longs because we know the market is going to go higher. And the same principles apply to absorption. Although absorption is much more technical and can be tricky to trade due to the ambiguity. And on occasion, it can be difficult to recognize as we only have 1 or 2 bars that give us clear confirmation that absorption is in process. And this comes right towards the end of price action. So let's dig deeper. Let's go into the characteristics. So we must have supply to the left, a bar or two, preferably a false breakout or an extended upthrust. Now, why is that? Well, the idea behind this is that we're looking for trapped traders. So think about this. We push up and we have an upthrust. As we know, it will penetrate resistance, reverse to close weak. So all these traders are trapped. they think the market is going up. So when price reverses to close back under and we carry on continuing south, they get trapped. So when we revisit the area, bear with me, let me draw this. Here we go. So we have resistance here, and we have an up thrust, or we could have a false breakout, either or. And these are the trap traders. So when they come back down, and yep, with the continue south, so all these trap traders in here are becoming very anxious. They're becoming emotional. So when we revisit this area, okay, they will exit their positions. So they went long here, and they will come out at break even, and they will have a nice sigh of relief. Also, there will be new support and resistance traders. So not only do we have all these people exiting which trapped here, so this causes supply, then we have new support and resistance traders here. So there's more selling here. And if the large funded or the smart money, they want higher prices and they're unwilling to let price go down, which of course is a characteristic of absorption. This is the whole name. We are absorbing all the supply to the left. So if we have a huge upthrust like this that penetrates, there's many trap traders. So this is the supply that must be absorbed over here. And of course, new support and resistance traders. And all these trap traders, when the market goes against you, not many people honor their stops, unfortunately. People become a bit frantic. They become very emotional. And we could have the best buying bars we could possibly see. So coming down here, we could have 50 bars. Then as we rally here, we could have the 4 strongest bars we've seen in 3 months. Yet all these people who are trapped here wouldn't recognize this behavior, these 4 bars of strength. They'd just be happy to exit at a very small loss or at break even. That's interesting behavior. Anyhow. And so that covers we must have supply to the left and why we're looking for a false breakout or an extended, a very large upthrust. In the immediate background, we must have strength. This is very simple. We must have evidence of demand overcoming supply. Buying of good quality, and we know what that is. It's simply a nice wide spread with good volume comparatively. When we compare to local bars, the spread should be wide, good volume, and we're closing firm, or there might be a bit of structure we're taking out. Okay, so it's just a firm close, increasing volume, wide spread, breaking structure, good SOS, a sign of strength bar. Now this is very important. At resistance, price must form a tight trading range, never more than 50% of the previous drive up. Tighter the better. The tight trading range is very important, and tighter the better. I say a nice, third to 25% of the previous up wave is ideal. However, Wyckoff stated that 50% is fine. Although from my personal experience and insights that I've gleaned into absorption, definitely tighter the better. Let me just show. So this is our move up. Now this is a very tight absorption. And Wyckoff says that we can have absorption up to 50% of the up move. So if this is our swing up, our leg up here, 50%, so we could have absorption coming down to this level. Okay? And this would be our top. However, think about this logically. The way I tend to think of it is, the way I think of the trading range is that there's less energy that is expelled. Okay, after all, in a trading range, we're building cores, like the coiling of an apex, like this. We're there's pent up energy. We're building cores. So if our trading range is this big, there's a lot more energy expelled in pushing price up and down in a trading range like this, as opposed to this. Agreed? And also, with a tighter trading range, I feel as if the buyers are more eager. They're holding gains. They're not willing to let the market react. They want all the contracts. And more often than not, again, from my personal experience, the tighter the absorption within the trading range, they produce more explosive moves. And again, stands to reason because of the pent-up energy. We're not expelling in this tight trading range here. The energy is concentrated, is the way to think of it. Whereas here we're expelling energy because it takes effort, force to push the market up and down. And here when it's tight, it's just, we're building more cores. I can't explain it any better. We're building more energy. Okay. Although Wyckoff states that 50%, okay, I don't find, so if we push up here, that's our swing, I don't find 50% to be a tight trading range from a personal standpoint. It's half the swing or leg up. Hence, a provisional guideline I tend to use is roughly a third or a quarter or 25% of the previous swing. Okay. Of course, it's very difficult to give exact numbers, but the more you study, the more you find them, you'll feel comfortable, and you'll realise yourself, or from the markets I trade, that a third or 25% is definitely a nice tight trading range that does produce explosive moves. Okay. Reaction volume. Reaction volume should remain low, and this is important. It should not increase. So what do I mean by this? Well, in the actual absorption area, so we push up, so this would be our absorption area. As we come back to test support, these little bars here, and we test support here, and we test support here, we want to see volume decline on these reactions within, like using our comparative and relative analysis within the trading range, the 2-minute tight trading range. Why do we want to see low volume on the reactions? Because this signifies or indicates simply a lack of selling pressure. Supply is drying up. So as we come back to test support, each and every dip down should draw out less volume. Each successive move, volume, as in here, should decline. Good. And not importantly, but lastly, towards the end of the trading range, price should hold higher lows with volume increasing. Now this is where it becomes slightly difficult. Within the trading range, towards the end, so we've got all this price action here. Towards the end, in an ideal world, we'd like to see narrow spreads like this, increasing with increasing volume. This is ideal, picture perfect. Spreads narrow and they rise with higher highs, higher lows, and all closing firm. Obviously, now you're astute market technicians and we can understand volume. We may think that this is effort versus result, and it is. However, it's bullish effort versus result. Why? Because of the context, because of the background conditions, because of those other points, those other 4 processes I pointed out previous to this. Okay, this actually is extremely bullish. And this is the final part of the absorption puzzle. Although I must point out that this doesn't always occur, but more often than not, More often than not, it does, and is very useful for when we recognize this behavior along with our other characteristics. This is the area we place a trade, a play to the upside. Because these bars, those narrow bars with increasing volume, is an extremely bullish case of effort versus result because of the context, because of the background conditions. You know, if we have all this in the background, all these four elements here, and we have high lows with volume increasing, we can place a trade. Very soon as we see the volume increasing in the tight spreads, we can place a trade. And this we would class as the typical completion of absorption. Price should now take off after, literally, when we see these high lows, these small narrow spreads towards the end of the trading range with increasing volume. This is it. This is liftoff. Price should now take off. It is very useful when the market provides optimal characteristics of absorption. Yet, as we know, the market is far from perfect. So as long as we have the other traits of absorption, these other four ones here, it's not needed to have the high lows with volume increasing towards the end. However, it does help because it's very easy to spot. We don't need to see the rise in lows with increasing volume. We can have levitating price action, and that suffice with sustained volume, and we can still comfortably trade this due to the lack of risk. Price should not close under the tight trading range or by the second or third narrow spread, and we've just put a stop under the low because we're either right or wrong with minimal risk, with much to gain, as supply by the process of absorption has been aggressively exhausted. So as long as we have a sign of strength behind us, supply to the left, a mini trading range with decreasing volume on supply bars, we can have positive price action in the form of a cluster in the closes that hold support, like this. Bear with me. So as long as we have all those other elements, so towards the end we could have these three bars like this with sustained volume. And this is like mini absorption within absorption. And we'd want to see, ironically, volume decrease on these bars. Because every dip down will draw out supply, reverse to close firm. We dip down, draw out supply, reverse to close firm. We dip down, find no supply, reverse to close firm. And volume decreases. Now that is not no demand on this narrow bar with low volume because of the background conditions, because of our context. This is bullish behavior within the realm of absorption. So we can either have three bars like this with decreasing volume, or narrow spreads. Obviously these have to be narrow relatively to the other price action in the absorption trading range, and we have these three bars with increasing volume. Now these three bars with the increase of volume is picture perfect A star. That's the ones that we can comfortably take a trade. However, we still have these three bars dipping down with decreasing volume. We still take the trade and we just place a stop under because the risk is minimal. Again, because the process of absorption is to exhaust supply, and therefore it's rarely tested. And when we take off and break to the upside, we don't come back down to test because we know there's no supply. That is the process of absorption. So we can carry on grinding higher and higher and higher. Therefore, if you think in risk reward terms, sometimes you can get 30, 40, 50, 60 to 1, which of course is phenomenal. However, absorption does not occur that frequent. Good. This concludes our introduction to absorption. Let's use our newfound knowledge and go through some examples.